Well, Park Plaza Apartments is to me, I think is a little gold mine. Excited about Park Plaza. Putting one of my tenants' mail on the door. All right, this is a no-no. Somebody with a bike. But yeah, Park Plaza, for me it's a gold mine just because the location of where we're at. The demographic, I think I was talking with you earlier about the particular demographic. You talk about real estate, you talk about location, but people don't really understand what that necessarily means. For me, location is based on demographics and psychographics. Demographics are who they are, psychographics are the why. And the why would you pay a premium for a building like this? Number one, brick and mortar, it's solid concrete block. The location's a garden style. You can pan around and get and I'll give the viewers an idea of what we're dealing with. It's a garden style apartment building, smack in the middle of downtown St. Pete. There's mid-rise townhomes going up right behind us.
Okay.
There's a high-rise right to the to our immediate left. You come out this gate, you go left, you go right, you go left, you're in the 2 blocks over from one of the high net worth blocks in the area. You head south or east, you run right into the water, another 2 blocks. So just the positioning of this building is key. So we talked about demographics and psychographics of this area, extremely important. I think this area, this particular property in and itself insulates itself from a lot of risk. When you talk about fluctuations in the economy and things of that nature, you have to understand what happens to the to certain demographics. What demographics are actually affected by a slowing down of the economy. I think everyone to a certain extent is affected. But high net worth individuals, their stocks may be at a low point, but they're still going to come and spend money here, on Beach Avenue. They're still going to vacation. And when they do, they still spend money at the bars, and the vast majority of my tenants here work in the service industry. So at the end of the day, they're still getting paid. So for each property has its own ecosystem. You just really, to understand the ecosystem of a particular property, meaning its area, you really have to drill down to the demographics and psychographics of that area. And to me, I think that is the most important thing or aspect to real estate investing. Everyone thinks it's the building itself, and the building is important, but understanding those demographics and psychographics and who your prospect tenant is now and who they will be in the future, I think is extremely important at the end of the day, man. So there's a lot that goes into real estate investing, man. That's more than just the brick and mortar of these buildings that you see, man. There's it's a science. And and I think for the most part, a lot of people don't really understand that. So, then for me, it's like, how do we take this building and leverage it if we choose? And if we do choose, and leverage, you got to be careful. That word is, that's like the atomic bomb when it comes to any business, especially startup businesses. The use of leverage can be devastating to companies. So you have to use that with caution. And when you take on debt, i.e. leveraging, you really have to be smart about it. Non-recourse loans and working with people, and understanding that, you don't want too much leverage. You don't want to be over leveraged. So, you just have to understand how to manipulate, play the game of Monopoly. And it starts with, putting some equity. In your young startup company, I believe equity. And I know that's contrary to what a lot of real estate investing books, everyone's always talking about owning real estate with no money down and stuff like that. And those are great strategies, and I'm sure those are awesome strategies. However, it's a little different when you're talking about multifamily, when you're talking about, apartment buildings. Typically you have to, money's got to come from somewhere. You're just not going to walk into a project like this without putting some skin in the game or some equity down. So, at the end of the day, For me, that no money down strategy is the ability to be able to manage the asset, the ability to be able to put the proper systems in place, the ability to be able to operate the property from day to day from the operational level. That is, what a lot of people can do to bring value to an investor and say, hey, look, that's my capital, that's my contribution, is the ability to manage and run this operation from day to day. So, that's my no money down strategy at the end of the day. You know what I mean? So, speaking of the devil, this is one of the real estate. Bryan speaking, broker.
Hey Bryan Chavis, how you doing?
Good. What's going on, man?
I saw you inquired on my Anderson House property, that deal off 2nd Street across from Park Plaza again the other day.
Yeah.
See if you had any interest there. I got some offers on it. We just hit the market again after the new year.
Okay. Yeah. Let me. I'm actually out here right now, at Park Plaza. Can we give you a call back in like 15, 20 minutes when I get done here?
Perfect.
All right, man. Thank you.
All right,
Yep.
So a lot of people getting into real estate, I would imagine, are looking for ways to do no money down deals.
Absolutely.
Yeah.
Absolutely. But again, like I said, is that actually a play for this type of, if you're flipping houses and things of that nature and you're into that wholesaling and, again, I'm not, that's not my area of expertise, so I can't really articulate on that. But, that's not the system, or that's not the segment of real estate that I'm in. I that's like 5 green houses. I don't want to deal with 5 green houses. I want to mess around with the red hotels. If you're looking at it from a monopoly perspective, which we all can identify with, for me, it's dealing at that red hotel. That's where you build wealth. The green house is how you can get rich. There's a big difference between being rich and being wealthy. Rich, green houses. Wealthy, red hotels.
So, we're not here to knock anybody.
Absolutely not.
But
No.
why do you choose this type of strategy, like using your expertise?
Well, think of it like this. And again, this is not knocking. You're absolutely right. However you got to get there by any means, especially if you know what you're doing. So, and that's why I always preference what I say is, hey, I don't know that industry. So, I stick to what I know. I stay in my lane. But at the end of the day, if you're in a fist fight, okay, just to give you an example. So if we're in a fist fight, the more moves it takes for me to deliver my knockout blow to you, the more risk I have of getting knocked out myself by you counterpunching, right? So the idea of flipping houses in 5 green houses, those are 5 transactions, which accrue a lot more risk to me. The more moves that I have to make to build wealth, the more risk that I accrue. So I can remove, based on the economies of scale, I can remove the amount of steps it takes for me to deliver my knockout blow by investing in multifamily, by benefiting from the economies of scale. So, the economies of scale is really important. So, and those horns are, by the way, are the horns of progress, because that's the lunch guy that comes here to the construction crew. So normally that's an annoying sound, but I love that sound because it's hustling, bustling down here in downtown. Everything's going vertical. But anyway, getting back on topic, man, for me, it's just removing the less amount of moves that it takes to build wealth. It insulates me from risk. It insulates me from the volatility of markets by benefiting from the economies of scale. And you benefit from the economies of scale in multifamily. If you have a single family home and you have a vacancy, you're 100% vacant. If you have a duplex and you have 1 vacancy, you're 50% vacant. You've just shaved 50% of your risk by owning a duplex versus a single family home. And if that single family home sits vacant for a couple of days or a couple of months, you've pretty much lost, your cash on cash return for the most part for that investment. So, there's, of course you can make it all back with appreciation after the property has been sold or whatnot. But if you go in banking on appreciation, that I think that's another like leverage. That's a formula that's setting you up for, for the possibility of a major fall. And that's what you're trying to always mitigate against, or not mitigate, but that's what you're really always trying to, shy away from is risk and volatility. Of course, we all know you can't 100%, you're not going to be 100% volatile proof. However, at the end of the day, Nate, you have to, I've got to be able to guide our investment group and to reduce the amount of, as much risk as possible. And you can do that through the economies of scale, owning more critical mass, owning more units. That call was from a broker that wants to sell that building across the street. So, you look at this building and you look at that. two different product types. I'm kind of wanting to shy away from that because that's a different demographic. Yeah, it made cash flow, but you're dealing with a different demographic. You have to look at where you're at, and how many, how many individuals do you have on your team. The more property you take on, the more, time and resources you're going to exhaust. So if we buy that, that could be a good move, but we also have to factor in, well, who's going to operate that at the operational level? And that's going to take a hell of a lot more time to operate than this building. This building, the tenants pay online. Like right now, just if you want to pan over to this window, that's an issue. I don't want, this needs to come down. I'm going to email this tenant. The bike in the courtyard, that's an issue. I'm going to email so I can respond to these individuals. Here's those tenants over there, they're not paying on portals. They're not responding through via email. Technology allows me to manage this building from afar through emails. And go back over here on this demographic, that demographic, trust me, that demographic probably doesn't have a bank account. That demographic probably doesn't have a smartphone. They're not able to pay their bills with a debit card or a credit card or anything of that nature. It's a different beast, a different animal. You're gonna have to physically be over there. That would be considered a C, D asset class in the middle of a thriving, booming ecosystem downtown St. Pete. Like I said, I think, that's a good strategy. I think that's a great buy for someone. But whoever buys that on the management side, they're going to have to be airtight. Would it be smart for me with a smaller team to do that? Probably not. The one down the street that they sold that I missed out on was a much easier deal because you're dealing with a light demographic at this building that we have. The demographic is very similar down the street, where they're paying their bills and they're doing things through the portal. You can interact with them through the portal. They have bank accounts. Here you're chasing your money with money orders. You're chasing your money here every day, knocking on the door, and I think it's a weekly rental too. So you just got to look at that and understand that would be considered I would say a D property, C at best. This was definitely a B plus property, and they're right across the street from each other. This shows you real estate at its best.
Yeah.
What's the difference between the two? The demographic and psychographic of the prospect tenant, brother. And if you think that you're gonna manage this the exact same way you manage that, you lost your damn mind. That is gonna take you a hell of a lot more billable hours to manage and operate than this. So you gotta understand, well, that's cheaper, Brian, or that cap rate is actually higher. It should be higher because there's more risk. It won't be, truthfully, it probably won't be because of the area and the location. You're basically buying and banking on the area. And again, now you got to look at it, and pan over there and look at it and say, do you want to take that risk? It's not bad, it's just the demographic that's there. So, if I had money and I were to actually bring that deal to the investment club, I would probably look at that and say, hey, look, what we need to do is we need to remodel it and we need to get rid of that demographic and trying to turn that into just an Airbnb. Get rid of that weekly rental, get rid of that demographic that's over there, that's hanging out, drinking beer and doing all of that. So, that project is going to be a lot more, that would be a lot more hands-on than obviously this one. This one was almost like plug and play.
So, there's going to be a lot of people that are going to be watching these videos and wanting to learn how to get into rental real estate for their own investments or learn to partner.
Want to buy it, rent it, and profit.
Buy it, rent it, profit. Why should they watch and subscribe to this channel?
Man, that's an easy question because it wasn't there when I started. There wasn't anybody talking like this, and for the most part, everyone who's probably talking and shooting videos, there's something behind it. There's a sale, and there's nothing wrong with that. This is a capitalistic, environment, this country that we live in. But at the end of the day, you just have to understand, sometimes it's, the right fit. There's the Grant Cardones, there's a ton of people out there talking real estate and telling you, hey, this is what you should do. I'm not telling you what you should do. I'm just simply opening up and showing you how I'm doing it. How you should do it, that's up to you. I'm just gonna open this channel up to you and we're gonna talk real estate. We're gonna show you what we're using, what technologies we're using, but I'm never gonna look you in the face and say, hey, this is what you should be doing. You should be doing whatever it is you feel you feel compelled to do. If you like what it is we're doing and what it is we're saying, we're gonna show you how we do it. And whether or not you do it and apply it and it's applicable to your own, self, that's totally up to you. But me and you, what we're gonna do is we're just gonna open up the we're gonna pull the curtains behind this thing and show you how it's actually really done. You know what I mean? And for me, for it to be raw like that, unedited for the most part, to me that's valuable. You know what I mean? I'm working with Mark Willis, one of the top CEOs in the real estate industry. There's a reason why I'm working with and attracting individuals like that. So no knock against anyone who talks real estate, but at the end of the day, you look at who my partners are and how I can attract those type of individuals. That's the kind of individual that I want to listen to. How did you do it? If you can attract the Mark Willis, then, wow, you know what I mean? And you only have a high school diploma. You didn't go to, a fancy business school. How did you do it? All we can do is just open up and be truthful and be transparent. And I think that's why, this channel is going to be a successful channel, just because of the transparency.